NG, what about this regional market? If you could pinpoint the exact reason or the exact geography or product which dragged it down on the whole. Was it India? Was it Middle East? Was it Diligenta? What was the key reason for this decline? What dragged it?
I think if you really look at the regional market, it's a collection of portfolios, right? It has a certain amount of our vertical products there, vertical services there. These are typically project oriented. They are not annuity centric revenue that we get in these regional markets. Okay, so these are they bring in volatility because the projects start and then they finish. And then when they finish, there is a drop, and then until it is again come up with another big project. So it's a combination of really a multitude of projects which are kind of closed during the last quarter or the beginning of this quarter, which has resulted in this let's say a negative growth in that particular segment.
But in which geography or in which product?
I think it's across. I should say that. Look, I don't think that it can be pinpointed to only India. I think India has done well for us this quarter. It could be in the in certain portfolios in Middle East, certain portfolios in Japan or in China, for example, right? So it could be a combination of these 2, 3.
Already we give a fair amount of segment information. So if you take another line and then drill it further down, it becomes this thing.
Largely Middle East, Japan, etc., where projects ended and you couldn't replenish it with new projects. So you said Q1 has been softer than what you expected, and it's also weaker than what we traditionally see. What are you feeling about Q2 on these two parameters?
We don't give guidance. It would be
qualitatively
difficult to say. We'll have to wait and see, because, as I said, it is a fairly challenging operating environment. We are positioned well, but we got to wait and see how it turns out.
The only other way to look at it is that, look, in Q1 we were in transition, right? I'll put it this way: the new service lines were settling in, and we have made these changes. And now I think they're all firing, and we should the demand environment out there for participating in some of those digital projects, we feel that it is better. So I'm an optimist.
Okay, so demand environment in Q2 looks better than what it was a year ago. Is that
I would say yes. I would say yes.
What about you?
He's an optimist.
doesn't mean that you should balance it out and be a pessimist. It really is. So according to you, is it?
As I said, it's. I would rather say that it's difficult to call, and we'll wait to see how it plays out.
Was the demand environment better in Q1 also, and it was only the transition and the internal factors which pushed growth lower?
I wouldn't say so, but if you really look at it, the volume growth of 3.5% means that, look, we did deliver in other words, it would have been a spectacular performance. I would put it this way, putting at 3.4% or 3.5% in volume growth. I think I think what Rajesh says is that, look, it's a tough out there. There is a stormy weather in which we are sailing our ship, and we are sailing it steadily.
Okay, just a couple of more questions on digital. Last time you said 55% of your clients, you were engaged with 55% of your clients on digital work, and the deal size has improved to about $10 million from a modest size earlier. On these two parameters, how would you rate the progress made?
The 55% we should be able to share with you, and the 10 million I don't offhand.
But has it improved, the deal size, say?
Yeah, I don't want to baseline to the 10 million. I don't
okay, forget the number.
This thing. Yeah, but on a like-to-like basis, it is actually improving. Digital deals are typically coming in larger than what they were, let's say, a year back, and much larger at many of our customer sets. The 55%, I don't remember the number often, but we should be able to share it offline with you.
Okay. What about on your, your capital allocation policy? It's been high, but it's been a bit choppy. For instance, if I take a 6-year average, it's close to about 80% of your free cash flow average, which you said you will maintain. But last year, because of the buyback, it shot up to 110%. Is it going to be as choppy, or do you think it will be a bit, if you could share, will it be uniform from here on?
As you said, the best way to look at it is based on its trend, and we had said that we don't see a reason for it to go down, and that 80% average is a good average. But will it be uniform, or will it be? We have typically followed a policy of 2 years and then flush out. We have had investors ask, some are very comfortable because it's been a very stable policy. Some investors have suggested that evening it out might be a better option. We are fully cognizant of that, and the board will take a decision, but difficult to call. But I would like to give the reassurance that we are among the best in terms of returning cash to the shareholders, and we'll continue to be on that journey and maintain the leadership position there.
On the subject of digital, you said the digital deal sizes are larger than what it was a year ago. But you know, when we speak to a lot of companies, they seem to indicate that the client allocation to digital has slowed down a tad bit. Would you agree?
I don't think so. No, absolutely not.
I don't believe so. I think, as I said, look, the large-scale workplace and workforce transformations are taking place. Their movement to cloud is a reality. Movement towards automation is a reality. Movement towards better customer experience and employee experience is a reality, right? So all these are, VC projects are there, and the integrated capability that we have put in place allows us to better participate in those opportunities.
Okay. Do you continue to stay as optimistic on the other verticals, barring BFSI and retail, like manufacturing, life science, energy, healthcare? Anything that you would like to call out?
Nothing that we would like to call out negatively. We're fairly, they're all fairly strong.
All of them have grown more than 3%, and some of them, like energy sources.
No, going ahead, I meant.
Yeah, I think the outlook is, there's no structural weakness that we see. In fact, even across the verticals, we don't see any structural weakness except the retail, which Rajesh articulated.
And lack of visibility on when BFSI, large deals in BFSI will start closing in North America.
It's equally our responsibility to structure the business case properly, right? I'd put it this way, right? Gone are the days where, people are willing to look at a 7-year business case for such a transformation projects on this thing. If we are able to come up with, let's say, a much shorter business case over, let's say, 3-year or a 5-year period, I think they will fly. That's my reading of the market.
Okay, just one final question then. Q1 softer than expectations. Qualitatively, if you could tell us, how would this year compare to FY17? Give us some qualitative statements about FY18 then.
Difficult to say.
Our digital revenue will certainly go up.
By 2?
Significantly, it will go up. I think, we have trained a lot of our resources. Let's say I put 215,000 people have been trained on digital capability. They're all acquired a phenomenal amount of competencies. It's a business which we are growing quarter on quarter at a healthy pace, right? So, and as I said, we are in a position to participate better, in some of those digital opportunities moving forward. So, without giving any future guidance.
20% of your revenues by digital.
Without giving any future guidance, but I think, we will definitely grow well in digital. And I think our transformation deals that we are working on, they're all shaping up well, and, wish us well.
Okay, gentlemen, on that note, we will wrap up this interview. Thank you very much for your time and speaking to CNBC TV 18. May you continue to remain an optimist and a realist, and all the best for the coming quarter.
Thank you so much.
Thank you.
Appreciate it.